So we now move into our the Q&A part of this evening. So we've got just over half an hour left, so it's a chance for you guys to ask questions. We're hopefully going to be able to keep Andrew online for the Q&A as well. And maybe if I might just start with one question to the panel, particularly to Andrew, because it's relating to the point you just made about social purpose becoming table stakes. And the question I'm wondering is whether we're sort of seeing a new form of social purpose, because we've all seen CSR as something that's perhaps done on the side of the company that monitors and manages, well, not manages, but particularly communicates. But whether we're starting to see a new breed of social purpose, and I particularly was taken by Facebook's IPO letter last week. So I don't know if the panel saw that, but I'll just read out a couple of parts from it, because so they were looking to list on the stock exchange, wanting to raise $5 billion, and Mark Zuckerberg, the founder, wrote a letter to potential investors where he said the first sentence was, Facebook was not originally created to be a company. It was built to accomplish a social mission, to make the world more open and connected. And he then went on to say, Facebook aspires to build the services that give people the power to share and help them once again transform many of our core institutions and industries, which is a very powerful statement. And they then went on to offer a dual voting structure, which gives investors a disproportionately low level of control over their business. So they're basically saying, we're on a social mission and we don't want any investor interference. And I think it's interesting on a number of levels. Is that a kind of new form of social purpose, or is that something that's been around for a long time? But also, if you do have a social purpose, do you have to tell investors that you're coming along with the ride but don't interfere, rather like what Paul Polman's been saying with short-term investors? So can I put that to you, Andrew, first, and then maybe over to the panel?
Sure, Jim. I think it's actually a really interesting test case, and not the first one, of an enterprise that is saying to the market, we are a social enterprise, we have a social purpose that we put first, and the investment community can participate in our growth and in our return on shareholder value. But they have to understand that what we're doing is mission-driven. Google said something fairly similar when it went public some 6-7 years ago. And shareholders have done pretty well on Google, even though it also has that same division in the classes of stock that allow for the founders to have a disproportionate amount of influence and control in the future of the business. And there are other companies that have the same structure. The New York Times, which is just right across the street from where I am today, has a similar structure, and it too would define itself, I believe, as a mission-driven business of delivering the news first and being a business second. So we are seeing some of these new structures, and in fact, new legal forms are cropping up, things called B Corps and flexible purpose corporations to enable this. And we're really at the frontier of whether investors will embrace this and allow it. Now, of course, there's great enthusiasm about the Facebook IPO. But these decisions about, control and governance are not without their concerns. In fact, in the newspapers over the weekend here in the U.S., there was a lot of commentary about whether Facebook is completely in the social good when it comes to practices like transparency and privacy and the disclosure of information and how that data is being used for commercial purposes. Now, of course, services like Facebook and Twitter and others have also been used for very positive aims and outcomes. Particularly, we saw last year with the Arab Spring and other social movements which are relying greatly on these services. But I think we're not going to simply have a buy or a pass for these companies. They're going to have to demonstrate that their mission and social purpose remains at the forefront, even as they grow and become public entities traded and listed on public markets.
Thank you, Andrew. Maybe, Karen, can I maybe put it to you? Unilever is a business we associate with social purpose and where the CEO has confronted short-term investors. Do you feel if you are to have social purpose, you need to do that kind of behaviour?
I think that the most important thing is to be able to look to long-term challenges and address the future challenges. So one of the things that Paul Polman did fairly shortly after becoming CEO of Unilever was no longer to give quarterly earnings advice, because consumers, brands, and the way that we run our business we're running it for the long term. And behind that, I guess, is a perspective on seeking to be more ambitious about the growth of the company. So we've said that we aim to double the size of the company, but that we can't do that at any cost, and that you know, within the context of increasing energy prices and the facing future food security issues and water scarcity, that we need to look to the long term in the way that we make decisions. That's really behind what he says, and I think it is a very important perspective on how you run supply chains and embed sustainability into the heart of your product, your brands, or your business, rather than having a separate, as you say, sort of CSR group, bringing it right into the heart of the operations.
Just, if anyone could raise any hands if they have a question, we'll just see if the other panelists meanwhile have anything to add to that.
Just to say that I mean, I think that the consequences for the financial sector of the sort of short-termism are very obvious to us all. We're still living with them. I think that it's interesting that Triodos actually has a governance structure whereby we have the shares are held in a trust. The trust issues depository receipts. So our shareholders or depository receipt holders have the same economic interest in the business as a shareholder, but they don't have the same voting rights. And that is clearly a construct to enable us to maintain our mission. And the shareholders seem perfectly happy with it. And it works very well for us, but that's what we have.
So for BMW, I mean, it's a part of our genetics, as you like, is the fact that we are a family-owned business. BMW was almost bankrupt in 1959, 1960, and the banks had already agreed with the dear colleagues in Stuttgart to make us the Daimler plant Munich. And it was a coalition of a new investor and the employees and the dealers which saved the company. And since 1960, we are owned by the same family and controlled by it. Our goal and our mission, as stated in all the papers, is to be the leading provider and producer of premium products and services. Leading today means having to have a superior performance in terms of sustainability. We want to sell cars which people do not need to get from A to B, but which they have to want for all the emotions and all the prestige they attach to it. We address people who have above average income and most of them above average education and knowledge about these topics. So you cannot lead in this field in the medium and long term if you do not can deliver evidence that by leading technology, by leading products, you are also in a strong position on the sustainability side. So both of this plays together, I think.
Very good, thank you. Should we go over here?
Dr. Becker. I think the automotive industry is one of the leading industries that are affected by resource price volatility. My question to you would be, what are the top 3 things you're doing to manage that within your supply chain?
Obviously, what drives us at the moment massively direct and indirectly is
the long-term increase in the price of crude oil. I mean, this is evident. It has also another means of transmission. This is the kind of industrial policies that result from this happening. If you take China, for example, everybody knows that China is one of the strongest and the most determined driver of the electrification of cars on the planet. And they do not do this, for example, because they have commitments in Kyoto, but they have other compelling reasons. I mean, it's dependency on imports from a region which is not under their control, but under somebody else's control. It is the fact that if you want to reduce dependency on oil, you have to do it in those sectors where you can do it. That's presumably not agriculture, that's not good transport, it's persons transport, it's individual mobility. And thirdly, they see the opportunity to leapfrog the superiority of the established car producing countries in the combustion technology by going into the field of electric mobility. So that is one example how different strategic factors interplay and motivate one of the decisive players of the future car business to go into this direction. So very clearly we are also driven by, for example, the policy of China, very clearly, like by the policy of California, who has been the most massive promoter of zero-emission driving over the last 30 years, and certainly also the ambitious targets the European Union puts on the car industry in terms of fleet average CO2 emissions is an important factor impacting on us. And very clearly, as a company like I described it, we cannot afford to pay, for example, penalties in Europe for not meeting our targets. So we better comply with these, like in every other place where we operate. But in addition to that, as you say, we move out of a paradigm where this is driven by governments and into one where we need this to be driven by customers. Because the kinds of vehicles I showed you here, they are going to be more expensive than a vehicle delivering the same basic service in terms of getting you from A to B in a four-seater at a given speed, for example. We want people to be motivated to pay a price premium for a car that is perceived as superior. And superior not only in the terms of acceleration, but superior in terms of the sustainability of the way we make it and the way we source the material, the way we provide our customers with the energy, for example, to drive it. So as a last example, if a customer comes to BMW and says, what about the electricity that goes into my car? In the European markets, we are going to give them the possibility to have as an option also the electricity contract coming with a lease rate, because we would not leave them alone with that issue. If they say, I don't care for that, I have the electricity at my house, fine with us. But those who say, I want also the green electricity coming with the vehicle, we will give them a possibility to do this. So many things interplay here.
Thank you. Now we come over here.
Thank you. Andrew Pidden from Deutsche Bank. Many long-established brands and companies are struggling to retain customer trust over environmental, social governance issues and working very, very hard to try and put themselves in the right position relative to both their competitors and I think their customers' desires. Are social media companies really different, or are they just too young and new to have really shown their true sort of business ethics over a full business cycle yet?
Is there anyone particularly want that to go to? Anyone? Andrew, that might be one you want to answer.
Yeah, my reading on it so far is that many of the entrepreneurs and founders of these new companies are coming to their businesses with a very strong sense of values and social purpose. They understand that so much of what they do is mobilizing people and trying to engage them in something that is of a higher purpose. And it's driven by communications and infrastructure, but there are other outcomes associated with it as well. And so I do think it'll be interesting to see as they evolve whether they can stay true to those values. And people have questioned that already about some of the companies we discussed, Google, Facebook, et cetera. There's an interesting case study already with the company Netflix, which I don't know if you all know, but which is an enterprise started here in the US, which allows you to rent movies either by distribution via DVD in the US mail or now via download. And they were a company that was doing very far-reaching things when it came to the culture of the enterprise and social purpose. But they also got tripped up by changing their business practices without really fully thinking through what it meant to their customer base, and their stock price as a result took a big hit, and they've suffered some sense of trust or lack of trust in the marketplace. And so it shows you how quickly you can build up that sort of storehouse of trust and goodwill, and how quickly it can be potentially lost if you make a misstep. So I think consumers today are increasingly expecting the highest from these new companies, but they're also fairly unforgiving when it comes to mistakes that they see made in the market.
Charles, have you got anything you'd want to add to that in a sector of trust?
The financial sector, a sector of trust, is that what you're saying?
Well, or one that maybe, and it came out, so there was a Needleman survey 10 days ago, where a global survey where the banking sector came last on the issue of trust.
Yeah, no, I mean, I thought you were implying something else for a moment, but that was a sort of worrying moment. I think, banks haven't always had that reputation. I actually joined Barclays in 1980, and it was still vaguely reminiscent of a Quaker bank, which is where its origins lie. And at the time, if I'm honest, we were a bit sniffy about that, actually. We thought it was rather old-fashioned and a bit sort of, from a different generation. And when I reflect on that now, I think we were wrong. And the advent of Big Bang and all that came with that in terms of the purchasing of these very exciting and very snazzy, racy, jobby and broking firms. And as I say, at the time, I thought that was terribly exciting. And the more I reflect on it, the more I think we just lost our way in terms of some of those underlying values. So I think that the position of the banks now, with this extraordinary, absolutely extraordinary sense of a lack of trust, is not where they've always been. And I think that some of these companies that we're seeing emerging now should also reflect on that, because what you see with something like Facebook is that there's an underlying sense of this being something that is really socially useful. I see it with my children, their ability to communicate with all their friends all around the world where we've lived. And yet at the same time, there is the opportunity to interfere in all sorts of ways and to bring stuff to them, and whether they be products or otherwise. So I think with all businesses, as they evolve and develop, there is the opportunity, or there is the potential to lose direction and lose some of that inherent quality. So maybe we should revert to our Quaker roots and in the banking sector and get it right that way.
Just also in that survey by Edelman, I think banks came last, utilities came second last, and governments fell in terms of trust levels, businesses fell. The only category that was up was people like you. So people were saying, I would trust someone like me more. I think it was about 80%, rather than banks were at 30%. And if you then look at the sort of peer-to-peer banking models like Lending Club, which has now lent half $500 million now, and Zopa, then if trust gets too bad between people and banks, and particularly if they think their capital might get stuck in banks, if banks have to get bailed out, then they may well turn to these sort of more online forms where they're actually saying, I'm trusting somebody else like me over an institution. So I think there is a real risk that the banks could be disintermediated by social media over time. There's a question over at the back.
Hello, good evening. My name's Kate Bull. I'm from the People's Supermarket. And I was very interested to hear what Andrew had to say in regards to social enterprise and social business being leaders of innovation and new business models. But one of the concerns that we have in that is that we are measured purely on what we deliver financially. And there is not yet, as far as we can tell, models where what we add socially and environmentally actually meet the triple bottom line. So people who wish to invest in our organisations like ours will expect us to deliver a similar rate of investment return, irrespective if we say this is what we deliver socially and this is what we deliver environmentally. They don't seem to balance up. And so I suppose the question for debates that I've got is, how can we make it balance up when we talk about creating new jobs or creating new ways of business, when the banking sector still only sees to measure return in one way?
Andrew, would you like to answer that?
I think the unfortunate truth is that this is all a complex balancing act. I mean, simply driving innovation around social and environmental issues in a business doesn't give one license not to continue to perform financially. The trick is finding that sweet spot where you really get the virtuous cycle of value creation by demonstrating leadership on sustainability. And so that comes from the focus on operational efficiency that we talked about as really now becoming a foundation or table stakes for any current business, as well as the understanding of the policy landscape, and then pushing forward on things like how can we use leadership and innovation on these issues to, frankly, get into new markets, to extend into new products and services, just as we heard about. You know, if you're in the vehicle business, going beyond thinking about vehicles into thinking about the modes of transportation and other services that one could be delivering value to customers around. So I think it will take time. It continues to be a balancing act. The more we hear from institutional investors, the more they are interested in these multiple modes of value, whether you call it triple bottom line or shared value, or whatever it might be. And some of the largest pension funds and institutional investors are looking at environmental, social, and governance factors. And I'm sure our colleague Charles Middleton could tell us more about that. But we're seeing it even in the largest financial institutions here based in New York, or whether it be other capitals, financial capitals in the world.
Yeah, I think it's there are sort of different levels. I think in terms of the sort of mainstream financial area, it's still a bit challenging. I think there is, and it was disappointing to see two of the biggest SRI teams, I think, sort of closed down in the last month or so. But there is that sort of SRI space, if you like, in terms of that focus on ESG factors. What is perhaps more interesting and maybe more relevant to you is what we experience, which is a increasing interest amongst the sort of slightly more philanthropic investment community, the high net worths who want to do something a bit more exciting with their money, the trusts and foundations who are trying to move away from a purely grant-driven strategy, who are looking for investments that do have that financial and also social environmental return. And I wouldn't pretend it's massive, but it's certainly growing. And we've experienced a lot of opportunities there where we've had projects that need financing, not debt financing, more equity type, venture capital type financing. And we found an increasing appetite amongst that group of investors for that sort of triple return. As I say, it's not massive, it's still quite fledgling, but there is something really quite exciting going on there. And if we can use that to leverage some of the more mainstream thinking around this, then I think there is huge potential.
Anyone else want to add? No. Have we got any more questions coming from the floor? Anyone got any burning thoughts? I quite want to know what people felt about the departure of the SRI funds, because I think there's an argument for saying that that's a positive thing, that SRI funds don't need to exist when it starts to become mainstream within investors. And certainly Aberley investors were saying they're going to now start to reward all their mainstream fund managers on their SRI performance. He didn't say how he was going to do that. Or do we see this as a negative move, that investors are starting to jettison sustainability when the going gets tough? And I'm sort of interested in views from here and from Andrew as well. Maybe starting with our panel here. Have you sort of got a view on that?
I don't know is the answer. I mean, I think, it takes out 160 heads. That's the cost cutting, which presumably they were quite keen on. I think the fund still exists. There has to be, I think, a bit of a question mark over what the future of them is if they do sort of put them back into on the fund managers. I don't know is the answer. It seems to be a bit of a signal that they're not taking it quite so seriously. The SRI industry has a lot of controversy around it if you really start to unpick it in terms of how seriously it really is developing a more sustainable investment scenario. And yet I think it has played a really important role. And I think we can argue it sort of should push harder, but it has played an important role, and it's part of that journey, if you like, for people to get into a more sustainable space. So I don't know. We've yet to see what happens to it, but it doesn't sound like a really positive step to me that two of those teams have been basically put out to grass.
Andrew, are you even aware of those SRI teams departing over here? Is that something that's hit the news in the States?
I can't say I'm aware of it. I've seen similar things happen here in the U.S. or elsewhere. And I guess my comment would be if we feel that the institutions that had been fielding those teams were pulling back from those commitments, then there would certainly be reason for concern. If alternatively, those folks are essentially being, if we could say, folded into the mainstream investment process, whether in those financial institutions or others, then I think it's cause for some optimism, because once people develop expertise in this area, there's good reason to hope that these things become part of normal practice, and one doesn't even need to call them out as being a socially responsible investment fund or advisor, but rather all of the investment advice, all of the investment activity is integrating into these factors of environment, social performance, and good corporate governance. And as I said earlier, the biggest financial institutions that we track, whether it's in the U.S. or elsewhere, are at least claiming that they are beginning to do that in a more sustained way. We need to see the results. We need to see whether those commitments bear out and are real. But the hope is that ultimately one doesn't need to go to a specialized socially responsible investment advisor, because frankly all investment advice, just like all good business practice, is being done in a sustainable, forward-thinking way.
Thank you. Over here.
Sustainable investment group within a large bank, perhaps I could just back that up by saying that actually what we are in the process of seeing in some areas, I'll just comment about my own organisation, is exactly that, the widespread adoption of ESG as a primary investment focus, and therefore effectively trying to get away from niching SRI, which has had historically exclusions that sit awkwardly with a broad investment portfolio mandate, whereas what now the focus is starting to become more apparent is on the sustainability of return. So if you like, sustainability becoming a more broad-based approach to investment returns, which is exactly how we see it reflected in industry. So instead of having green consumer companies and green production companies, you're starting to see just sustainability across the entire spectrum of the economy. So the same is occurring in some organisations within the financial sector as well.
Thank you very much. Now we're probably going to have time for one more question after this, if there is one. Yeah, we've got two. Let's move quite quickly.
My name is Alexander Heining of Alphion Energy. You wouldn't be sitting on this panel if sustainability wasn't an important part of your business strategies. My question is, in the past 3 years, so instead of looking forward, of these 7 dynamics that we have here, which ones are the reason that your businesses are still, that sustainability is impacting your business strategies?
Good question. So have you got the 7 trends? Hang on, we might need to ask you to relinquish them. Go ahead. Thanks, Ben. There we go. The question is, I think, excuse me for paraphrasing, of these 7 trends, which of them over the past 3 years has driven sustainability most centre ground into your strategy?
Well, I would, if I could respond for Unilever, I think if looking back over the last 3 years, the key factors, I guess, that have driven us have been, and which are part of our business case today as well, I would say, is first of all looking at developing new markets. So the last of the drivers. About half of Unilever's business is in the developing and emerging world, and it's in those very countries that people are facing some of the biggest effects of climate change and water scarcity and worsening hygiene and sanitation. And so our sense is that if we can provide products that will meet the needs of those consumers both today and tomorrow, then we're more strongly positioned as a business to grow. And so there's a very strong growth agenda there. The second area, which is a key driver, is business efficiency, and I think that's both in terms of reducing the costs associated with manufacturing, like energy costs, for example, but also in terms of cost cutting and a more efficient use of resources across across the piece, and particularly, I mean, an obvious one is in packaging reduction. And then I guess the third, which has been important to us for some time and continues to be so, is collaboration, which I talked about earlier, and some of those key partnerships.
Thank you. Thomas.
So I think in our case, it's the interplay between policy and new markets. I mean, what we have been seeing with the new technology options that came up with a view to alternative drivetrains would not have, having had the impact it has without the interplay with governments. Very clearly not. I mean, we are faced with expectations, be they named CO2, be they named energy independence, which we will not be able to meet with today's technologies. But these requirements only exist because also government knows that we have new technological options, which we in return have to make a success. So these things come together and have a mutually accelerating effect, if you like, on the discussions we have. 4 years ago, 5 years ago, nobody in the European arena talked about shares of electric vehicles of 5 or 10%. Nobody. So, and now we are expected to deliver 20 next year if one listens to some of the expectations out there. So these things have, I think, a very strong impact upon us.
Thank you. Charles.
It's slightly difficult to answer in a way, because I suppose as we were set up 31 years ago with a social environmental purpose, in a way it's different dynamic. But so that's all we've done. That's all we set ourselves out to do. I think what is interesting is how some of these have sort of come to bear and interacted with that initial purpose. So, you know, we were doing small-scale wind farms in the UK when they were, shall I say, even less popular than they are now, when they were extremely, just people thought we were mad. But what has happened over particularly the last 3 years, of course, is we've been able to, with the expertise and the experience we developed, play into what is a very different market driven by policy and so on and so forth. So I think it's more actually what these have done to play into the model that we've always followed. And I want to give this back because you've put social purpose on it, and I think it...
Now, I think we might make this the last question because we're running out of time. Andrew, is there anything you'd like to add to that?
I think I gave you my bias earlier, where I think all 7 of these factors are important. Some of them today, in my mind, have become almost, they are absolutely expected of every business. So looking at efficiencies from sustainability, from energy savings and so on, I think is just got to be core to your business. To me, the most exciting and interesting drivers are going to be around things like innovation and new markets. The other small thing I want to add that I think is particularly exciting today and necessary when it comes to collaboration is thinking not just of collaboration between big business and government or business and NGOs, but between large enterprises and the innovation community. So entrepreneurs, scientists, people starting new companies. I think that's what's exciting about a few of the partnerships that were mentioned. That's where we're going to get a lot of the value in driving progress on social and environmental issues, is when you combine the enthusiasm and the passion that you get in the entrepreneurial community with the scale and know-how that you get with large enterprises, and put those two things together. It's a recipe for success and progress.
Great, thank you very much. Well, listen, before we thank our panel, just 2 things. Firstly, please can you fill in, just tick your 3 boxes that you think will be the biggest trends going forward over the next 24 months. Write your name and the email address at the top as well, please. And then we'll have the results of that by the end of the round table, and we'll put them up here, and we can see how, A, what's come out of this evening's discussion, but B, how it compares with what was filled in before. Second thing I want to mention, and can you make sure you give all your forms to the chairs of your table, and they will then be collected up magically just at the beginning of the round tables. Second thing, FIFO. We talked back in November about Charles Truett Shirts using FIFO to build transparency into their business. We're going down the same road after talking about it. So please, all of you will get an email this evening about 9 o'clock asking you to rate your 3 different areas of Green Monday. Please do it. It's going to help. You're helping us to help you. And we'll also find out which were the most valuable roundtables of the night, and we will let you know which the top 3 were. So the final thing is just to thank our panelists on both sides of the Atlantic. It's been quite a big and challenging topic, but I think you've done a really good job tonight. So thank you very much to all of you, and thank you to the audience.